Kobus Nell joins us for the second half of the show as well. And we're going to start off talking about the demand for resources in China. Just in terms of the supply-demand balance in the platinum industry, Johnson Matthey came out, they said last year the market was in a surplus of about 300,000 to 400,000 ounces. This year it's going to be a lot tighter. Do you think that, because of what's happening at Amplats and Lonmin, we're going to see the platinum market move back into a deficit in the next few years?
If we say Amplats do cut, say 200 to 250,000 platinum ounces out,
which is about 10% of production at the moment, plus minus.
Then one will see ultimately, in 2013, with some pickup in demand, that the market may trade a lot closer to a balanced market. Obviously the 2012 year has been hampered by all these strikes and loss in production from those mines that's been impacted, which is Impala, Lonmin and Anglo Platinum, and some of the other smaller miners to a lesser extent. And from that perspective, we're sitting in a market in 2012 that may just as well be in deficit, but not a structural deficit as we speak. And I think if Amplats sort of move on that, it may relieve some of that that position where we're adding to stock every single year for the last couple of years. And that should improve, I guess, the sentiment, or start to improve the sentiment around the industry. But ultimately you need stronger demand, really, for these companies to benefit to the extent I think we've seen in the past, and to the extent many are hoping for, is we need to see the higher cost production coming into play, so that the price can actually be drawn up by these higher cost production, and that the companies that got lower levels of production cost can actually benefit from higher returns. And the only reason you'll basically get it is from stronger demand, and specifically from Europe being the biggest customer for the platinum industry.
Things still look tough in Europe, but just to touch on Lonmin, they've also in the process of restructuring. They've come to the market, and they're going to be going through quite a massive rights issue. What do you expect from Lonmin going forward? Is it offering value yet, or which of these majors have you been interested in?
Look, Lonmin is one where they've got a lot to prove now. They've just come out of that horrific strike action and the tragic events that played out at Marikana, and then the massively dilutive rights issue that we've seen in the company. And they are regrouping now. They went back to the drawing boards. They lowered their level of production to about 700,000 ounces for the next couple of years, 3 years or so. Nameplate capacity is probably closer to 900 to 950,000 platinum ounces within the company. So they've got a challenging task now to actually try and reduce the processing costs, the overhead costs, and everything else, and actually improve the relative position of the company on the cost curve. As it currently stands, the company is running risk of actually breaching covenants again in 2015 towards 2016, perhaps on our numbers, unless we see a very strong recovery in demand and the underlying prices in the environment. So it remains a play which have been hammered, in terms of price performance, but it's still in with tough times. It's still got a lot to prove now. As I said, it's got to try and show to the market that it can actually cut back its production profile and reduce its cost, and ultimately improve the general profitability of the company. So it's a high risk play with potential good upside. Potentially good upside, but as I said, it is one where we still got to see a lot of work from their side.
Are there any platinum mining companies, especially in the junior side, that are generating free cash and that are making profits in this environment after they've taken into account their capex costs? And are you buying any of them, or have you bought any of them recently?
So look, companies we've liked is, I think in this environment where we're going into, is companies that are generally lower cost producers, or it's companies that got strong volume growth. And the one that's more on the low cost producing side is Impala Platinum. Now that's not it's one of your three majors, PGM majors, But in an environment like this, it's been a name that we've liked for a while now, in the space specifically, and its ability to actually deliver, and they are investing through the cycles, and I think if we want to get to a point where the market do turn, they have invested at these lower type of return levels, and and they're in a position then to reap the rewards. Another two smaller ones is Northern Platinum, which is busy on their ramp up at the Boysendal, new Boysendal mine. So that also offers very attractive volume growth over the next couple of years, with some optionality on a phase 2 program subject to Eskom power. And then, the third one maybe is something on Royal Bafokeng Platinum, which is also embarking on their Styldrift project, and also got some nice volume growth. It's got good quality Merensky reef in the Western Bushveld. It's strategically positioned, that makes it a target perhaps for some corporate activity later on. That sort of gives some underpin to the price. So those are, I think those are the names, that we found attractive.
Turning our attention, I think, to the broader resource market, obviously one of the big underpins for resources over the last 2 decades has been the Chinese growth story. We've seen the transition of leadership now in China. What are you anticipating in terms of demand for resources from the world's second biggest economy?
I think it's important to sort of look back and what the Chinese have done in terms of demand for commodities when we came out of the global financial crisis. We've seen import volumes just coming out of that, record iron ore import volumes, and so in many other of the commodity types. And I guess the question was, what recession are we in? If we keep on seeing these type of numbers coming in, and as time went by, it became more apparent that they've actually front-loaded a lot of their capital expenditure, i.e., creating a lot of infrastructure and floor space within the country that's sort of been front-loaded. Unfortunately, as they were slowing off and sort of trying to moderate back to more realistic growth levels, trend growth levels, that's supported by their industrial urbanization trends and underlying industrialization. They've been exposed to the European crisis and the slowdown in growth that we've seen there. And we've seen how it impacted their exports. One third of China's exports is actually going into Europe. And we've seen again then on the back of that how the lower export to Europe is impacting Chinese imports from many other countries. And so we've sort of moved into the softer period that we've seen the last couple of months. We've had the leadership change playing out there now, and everyone is waiting and to see what will happen. But I guess, the expectation of a massive liquidity injection, like what we've seen in 2008, probably where you had it at national and provincial level of over 10 trillion yuan being pumped into the economy, that is unlikely to sort of play out again. That I think, the consequences that we've seen on the back of that, has been noticeable, and they are still trying to deal with many of those issues. So going forward, we do expect there may be some stimulus from their side, but I guess it's not a case that we may see it to be as aggressive as we've seen in the past. So I think expectations got to be moderated in terms of demand in general, what we can expect from them. We still believe they are in the industrialization process, and demand for commodities will remain strong. But I think expectations just got to be moderated down.
Just in terms of the demand, many people are talking about how the country is now moving, and how the authorities want to move the country to a more consumer-driven economy as opposed to investment and export-led economy. Does that mean a change in the composition of the resources that they require?
Ultimately, you would think they would require more of the later cycle commodities, the likes of oil and maybe your precious metals and diamonds and protein, and the likes of potash and those type of things. As people get wealthier, and as they can sort of, and as we sort of see the general wealth of the country increases. Saying that, I think they're still in a process where steel intensity is still at reasonable levels. for most likely for the next sort of couple of years or so. Maybe not at a rate as I pointed out to you, that what we've seen prior to 2008, but still at reasonable levels of steel consumption. And that remains probably the most important driver, I think, for most diversified mining companies, is that iron ore component and the kind of earnings that the companies have received from iron ore, and the margins we see now. Obviously, as more and more lower cost iron ore is set to hit the market, the price is expected in the next couple of years to moderate it down to sort of more the longer term price levels of, let's call it around about $80 per ton on a free on board basis. So from that perspective, there is still room on the earlier cycle commodities of iron ore and coking coal that obviously goes into steel. But obviously as time goes by, one will expect a higher proportional demand perhaps from more, for some of these later cycle commodities.
Just in terms of infrastructure, we've seen and we've known for a while that the South African government's wanted to embark on about an 800 billion rand infrastructure program, and that it's using its state-owned enterprises like Eskom and Transnet to spend a large bulk of that majority. And recently we've seen signs that the wheels are in fact starting to turn. We saw the announcement by PRASA the other day that they had procured about 50 billion rands worth of passenger railway inventory. We've also seen very quick rounds in the renewables energy space around putting renewable energy onto the Eskom grid. And so there are signs that things are starting to happen. Are you optimistic that the country's going to kick on and spend that money on infrastructure and in so doing, lift the demand for resources and the general economic activity?
I think firstly, it is probably something that will play out, and probably not in the time span that they sort of pointed out it will happen. But ultimately we need to see this infrastructure, there's investment in infrastructure, otherwise, the capability of the of the country will get run down, and we will find ourselves in a position where it's not productive for economic growth. So I think it's an area that's non-negotiable. It's got to happen at some point. But indication at the moment is it will probably happen at a slower rate than what was sort of alluded to initially when they sort of announced these spending programs. So I think that's the first important point. The second one is I don't think our demand is really that substantial to impact commodity prices in general. It remains I think to a great extent of what China and what we'll see of China and the type of demand growth levels we'll see out of China. I think that still remain the most important area for commodities in general and commodity prices.